What's up guys, Tim Erickson back for another video. This video we're going to be explaining the vertical spread option strategy that I'm going to be using pretty widely here in my $10,000 to $100,000 challenge. For those of you who haven't been following the challenge, please look at the link in the video description below to follow that series as well. It's a challenge where I'm starting with $10,000 on Robinhood, attempting to turn it into $100,000 as quickly as I can. We have only just begun the challenge, so you won't have too much to catch up on, but this video is going to be explaining the vertical spread strategy that I am using to generate much higher returns than simply buy and hold strategies. So I did another video where I explained kind of the basics of call and put options previously. This video is going to be diving into more of the option spreads, and so without further ado, let's go ahead and look at an option tree here. Again, going back to Amazon just as our example. Coming down here to our current strike price of $3,053 on Amazon. So as those who have been following the challenge are aware, I've been doing a lot of put credit spreads, and specifically, which is trading on put options. There will be times where I'll do the same thing with calls, and I will show you in this video what that looks like also, but for now I've been focusing mostly on puts because in essence what this strategy is betting that the market price of a stock won't drop below a certain amount. So it's not that it won't drop at all, it can drop, it just we're betting it's not going to go below a certain price, and in the event it stays above my strike price, then the options expire worthless and I get to keep all premiums received when the options were opened. So that's the gist of the strategy, but the way we're going to do it is we're going to look at one that I actually did open up previously just this last week. I got a slightly higher credit than it's going to show now, but I did an April 30th expiration put option. And so what I did was I said, alright, the market price is currently a little over $3,000. We are a little over a month away from April 30th. Today's March 20th actually, so we're about 40 days away from expiration here. And what I did is I went down all the way down to a strike price of $2,750, right? So $2,750. So you see $300 below the current market price, almost 10%, right? You see this -1 and +1 means these are the options that I traded. But anyways, if you click on one of those options, so say starting with the $2,750, you'll see the kind of bid-ask prices. Now these won't be perfectly accurate because the market is closed today on March 20th, but when the market's open, these change quite frequently. But for now, just for example's sake, the way you would execute the vertical spread strategy is, again, I want to be a premium seller and I want to be the one collecting premium on the options. So this -1 here means I sold the $2,750 Amazon strike price option. So in the event Amazon by April 30th is still above a price of $2,750, these options will expire worthless and I'll get to keep the entire amount of the credit I received when I opened them. So what I did is I sold this option. So if you see here, I have clicked sell and put with this strike price, and I'm going to click to add this order to the queue. Now, Robinhood does have several different levels of options trading that it allows. I am approved up to level 3, which means it does allow me to do spreads. If it doesn't allow you to do spreads, which is when you trade multiple legs of an option at the same time, then just with a little bit of option experience, I'm sure they'll approve you, before too long, but they might want you to trade a couple normal options first. I don't know. But anyways, so the first part of this trade was I sold this put option, right? So as you'll see here, this put, for those familiar with puts, $2,750 strike price means that somebody has the right to sell me 100 shares of Amazon at this price by April 30th, right? So normally in order to open this put, I would need to have 100 times this amount, or $275,000. I have that much money. The other way I did it is I went ahead and covered it by buying this put option, right? Which means that I would have the right to turn around and sell 100 shares of Amazon to somebody else, whoever sells this option, at a price of $2,740 each, right? And so the way you execute it on the spread is you come over here and now you click buy, and I click to buy this option. And so as you see here, Robinhood automatically calls this a put credit spread. Some people call it a vertical spread, but same thing. So we are selling the April 30th expiration 27.50 put, buying the same expiration date put at a slightly lower strike price. So when we sell it, we receive a credit of this amount per share, again times 100 shares. And to buy this put, it costs us this amount per share. The difference between these two is a net credit of $1.50 per share. Again, since it's 100 shares, means we would receive $150 for opening this position. Now, when I opened it, I actually received $170 because the price was a little bit lower at the time. I got a little bit better of a credit. But the reason that's important is because I bought this put now, I no longer need to hold $275,000 as collateral. They only make me hold $1,000 as collateral, and I'll explain why. And that $1,000 is essentially the difference between these two strike prices times 100 shares. So we have a $10 difference here, and then if you multiply that by 100 shares, 10 times 100 is 1,000. So they're only holding $1,000 as collateral. And the reason they don't need to hold more is because in the event Amazon price tanks and goes way below these prices, yes, I might be assigned to buy the shares at this price, but I also have the right to make someone else buy them at this. So my max loss, if I have to buy them for this, would cost me $275,000. But I could turn around and sell them to somebody else for $274,000. So that $1,000 difference is the amount of collateral they make you hold for the trade. So that's the advantage of doing spreads, is it lets me trade options on Amazon where normally I would have nowhere near enough money to sell this put, but now I can because I'm covering it by buying the lower put, only holding $1,000 collateral, and getting my credit of $150 or in my case $170 when I opened it. So now those who have been following my challenge will also be familiar with the fact that I'm actually not even holding cash as my collateral. I'm using my available margin for my options collateral. So it allows me to take that $170 credit that I received and reinvest it in buying some stocks, which is what I have been doing. So as you see here, this is my current portfolio for the challenge. This will be updated at least weekly, hopefully more often if we have exciting things to talk about. But if I come in here, I can click on the spread that I opened, and you will see here that this is the current market value of 150 like you saw. It says I received 170. Has that expiration, and it kind of breaks down the individual contracts as well. Here's the execution price where it says I opened it yesterday for $170 and yada yada. So that is the put credit spread. Now you could do the same thing with calls, but it's essentially the opposite bet. So for a call, or let me back up for a second. So for the put credit spread, again, we're betting that the market price is not going to drop below a certain level. In this case, that level was $2,750. I'm betting by April 30th, Amazon is going to stay above this price. Someone calls switch to puts. Right? Betting Amazon's going to stay above this price by April 30th. In the event it does, both options expire worthless, because if the market price, even if Amazon drops all the way to 2,800, nobody's going to want to sell me their shares for $2,750 when the market's paying $2,800. So as long as the market price is above this, the options expire worthless. I get to keep that entire $170 that they paid me when it opened, and the collateral at that point would be released. So that's the goal. If we were to do the same thing but with a call, we would do the opposite. So instead of going below the market price, I'm going to go above the market price and switch it over from a put to a call option. And in this scenario, it's kind of the opposite bet. You're going to bet the price is not going to go above this limit. So if I were to take this 31.90 call and say, all right, I think the market price is going to stay below 31.90, then I could sell this call for this credit, right? Problem is, in order to sell this call, I would need to have 100 shares of Amazon, so that in the event the price did go above that, I would have the shares to sell someone. Since I don't, what I could do is turn around and buy the $3,200 call. By buying the $3,200 call, now I don't need to hold 100 shares of Amazon, because if the price runs way up above 3,200, by buying this call, I can buy them at this price to then turn around and sell them at this one. Now, obviously that's not what we want to happen, because as you notice, I would be buying them at one price and selling them at a lower one. So I would be incurring a loss in that scenario of $10 a share, or each contract is for 100 shares, so for each contract that would be a loss of $1,000, right? Now that is the max potential loss on a trade like this, but again, the hope when you enter this trade is actually that the market price is going to stay below this amount. So doing the vertical call strategy here, where you're selling the vertical calls for a credit, is what you'll want to do when you are betting that the market price is not going to continue to rise up too quickly. It's not going to go above a certain point, right? Now, you will notice that in my trades, I like to pick strike prices that are pretty far from the money, pretty far from the current market price. And the reason I do that is I want a really high chance of success, because I'm not trying to have these options assigned. I want them all to expire worthless. In fact, frequently, if it looks like an option might be in danger of getting the money, I'll probably just look to cut my losses and close it early rather than incurring the max loss. But this is how you would construct the vertical call strategy, and again, the put strategy is what I used previously. You will probably see me doing more puts than calls, and that is because just in general right now, the way I feel about the market, and again, this is just my opinion, I'm not a financial advisor, but as the economies start to reopen in the post-COVID world, as well as all the massive amounts of stimulus money and government spending going on, I think a pretty big drop is unlikely. Obviously, it could happen, but with things opening up and all the government money floating around, it's not something that I'm betting on. I'm betting against that. So again, and my strategy doesn't say that the market's not going to go down at all. I'm just saying it's not going to have the bottom fall off it and plummet down through the roof, right? So in this case, Amazon can drop $300 and I'm still fine. At $27.53, this option is still worthless on April 30th. So I just need it to not completely fall off. So that's the main strategy I use. We will be employing this strategy over and over and over again throughout the course of the challenge. As you'll see here, this is a little over a month till expiration. I do prefer to have my contracts be in that 30 to 60 days window until they expire. Sometimes we'll go a little longer, but the reason I like to be that short is because that's when you get the most time decay on your options. And time decay is basically the term they use to describe how an option loses value as it gets closer to its expiration date, right? If you buy or sell an option 6 months from expiration, your first 3 months, there's probably not going to be much in the way of time decay. But the last month, and specifically the last couple of weeks, is really when the prices on the options start to go down. And again, since I'm the one selling the options, I want them to go to zero. So that's what I want. So the quicker that happens, the sooner my collateral is released, and the sooner I can get back to making a new trade and making more money. So that is the explanation for the put and call spread strategy. There is also a strategy that some of you might have heard the name of before called an iron condor, which essentially just combines the two strategies. So in this case, I still have my call strategy loaded up, so if I come down to a put and I open a put spread for the same expiration date, you will see here, if I click to sell the 29 and buy the 28.90, it is now called this an iron condor, right? And so an iron condor is just the combination of a put and a call credit spread. The benefit of doing an iron condor is you still only need $1,000 collateral, because if you think about it, one side of this trade, either the call or the put side, is guaranteed to expire worthless, right? It is impossible for them both to be in the money. So by opening them together as one, we can limit the amount of collateral we need. In this case, again, only $1,000. And yeah, we can go from there. Now, this isn't one I'm going to recommend opening, because these are prices that are a little too close to the money for my comfort level. But as you can see here, you get a lot bigger of a credit. So if I were to try and place this order, I'd say one contract at that price of $5.98, you'll see for 1,000 collateral, I'll get $600 credit, which is amazing. Assuming the price does stay in that range, it expires worthless, and that's great. So that is kind of the basic version of the strategy that I'm using. I will do a subsequent video that will explain the benefits of doing the spreads over just normally selling puts or calls and vice versa, and how that pencils out and why I think spreads are the superior way to go. But for now, again, this is Tim Erickson. Please subscribe to my channel so you can get updates on my $10,000 to $100,000 challenge. If you enjoyed the video, please consider leaving a like and or comment in the video below, and look forward to following up with you guys with the next update. Thanks.